Today we are going to learn the basics of stock market. What is stock market? Companies need money to run their businesses. Sometimes the profit earned by selling goods or services is not sufficient to meet the capital requirements. So, they invite normal people like you and me to put money in their company so that they can run it efficiently. In return, investors get a share of whatever profit they make. Understanding this is the first step towards understanding stock markets. Shares. What are shares? Shares are a way to own a part of company's value. In proportion to the capital you invest, you get an ownership right to a certain percentage in the company. Say you own 2% of the shares being traded in the market, you can say that you have 2% ownership in the company. Hence, shares are units of ownership in the company and its financial assets. Shares are also known as stocks, equity, scrips, etc. After purchasing shares, you will be known as a stockholder or a shareholder of the company. Why does a company need share? A company needs money from the market. As mentioned earlier, when company scales up or expands its business, it needs more capital. During such times, the company taps into the share market and offers a certain number of shares based on its market value, which the investors can buy. The investors will be paying a certain amount of money to the company, and in return, they get to be a part owners. So, when the value of share rises, the value of share investors on rises. Investors are, however, not lending money to the company, so they are not creditors. This indeed share market basics for beginners because it's essential to understand why companies need shares at all. How does a company list its shares? Another important aspect of share market basics is IPO, that is, initial public offering. The first time a company offers its shares to the public, it is called an IPO. SEBI, the Securities and Exchange Board of India, is our market regulator. SEBI has laid out a few rules and regulations for the company to list its IPO on exchanges, which they have to comply with before being eligible for listing. What is SEBI? Securities and Exchange Board of India is a securities market regulator to oversee whether any fraudulent transactions and activities are made by any of the parties, that is, companies, investors, traders, brokers, and the likes. What are stock exchanges? A stock exchange is a place or a platform where traders and buyers come together to buy and sell stocks. There are two primary stock exchanges in our country: Bombay Stock Exchange, that is BSE in short, and National Stock Exchange, that is NSE. Stock exchanges are secondary markets where existing owners of shares can transact with potential buyers. The overall market is made up of millions of investors and traders who may have differing ideas about the value of a specific stock and thus the price at which they are willing to buy or sell it. A stock exchange provides a platform where such trading can be easily conducted by matching buyers and sellers of stocks. For the average person to get access to these exchanges, they would need a stockbroker. The stockbroker acts as the middleman between the buyer and the seller. What are NIFTY and SENSEX? All companies who want to get listed approach either NSE, BSE, or both. All stock exchanges need equity benchmarks to signify the trend in the stock market in the best way possible. Both NSE and BSE have hundreds and thousands of companies listed on them. But if you have to pick the top 30 stocks or look at what the bottom 100 are doing, it will be difficult for you to siphon through this huge number of companies listed. What indices like NIFTY and SENSEX do is to group them together. Nifty 50 is a collection of top 50 companies listed on NSE, and Sensex is a collection of top 30 stocks listed on BSE by way of market capitalization. The top companies are the ones that influence the stock market the most and influence the country's economy the most. Hence, an index with the top and largest companies is the best gauge for how the entire stock market works. There is also BSE 500, Nifty Mid Cap, BSE Small Cap, and many more such indices. However, Nifty 50 and Sensex are the primary benchmarks. There are sectoral indices as well. Nifty Pharma, BSE Bank X, Nifty PSU, and many such sectoral indices that group the stocks in each sector, which help us to understand how the sector is doing. In short, indices tell us in short, concise, and easy way how the market is doing. How do you make money? Naturally, when you buy shares at a lower price and sell it at a higher price, you earn the capital gain. However, there are two ways you can do this, and if you are a beginner, it is especially important for you to know the difference between stock trading basics and stock investment basics. There are two ways, that is stock investment and stock trading. Stock investors. Stock investors are those who keep their money in the stock for a long period of time, sometimes even years. Returns are compounded over a period of time. Investors use fundamental analysis. They look at the growth trajectory of the company because your investment literally grows with the company in the long term. And next coming stock traders. Stock traders are generally buy and sell within the same trading session. They use technical analysis to understand which stock is the best to invest in. Traders look for short and quick gains. Stock trading basics will require you to learn technical indicators like momentum oscillators, Bollinger Bands, charts, and much more. How do you start trading or investing? You need to open a demat account and a trading account. Most investment platforms and brokers these days provide you with demat come trading account. Trading account is used for just the transactions, that is buying and selling. Generally, if you are a trader, you don't really need to open a demat account because if you are selling and buying within the same day, a trading account will suffice. Demat account is where the shares are stored in electronic form. Generally, it takes 2 working days for shares to get dematerialized and transferred to your demat account. So after that, if you buy or sell the shares, it gets debited or credited from your account. There are a lot of trading platforms or stockbrokers available like Zerodha, Upstox, Edelweiss, ICICI, etc. I am giving one of the link. If you want to open the trading account, you can do so. But the caution is there not to start the trading unless you have learned the stock market, its advantages and disadvantages completely. If the thought of investing in stock market scares you, you are not alone. Individuals with very limited experience in stock investing are either terrified by horror stories of average investor losing 50% of their portfolio value. It is not surprising then the pendulum of investment sentiment is set to swing between fear and greed. The reality is that investing in stock market, of course, it carries risk, but when approached in a disciplined manner, it is one of the most efficient ways to build up one's net worth. Numerous studies have shown that over a long period of time, stocks generate investment returns that are superior to those from every other asset class. Stock returns arise from capital gains and dividends. A capital gain occurs when you sell a stock at a higher price than the price at which you have bought it. A dividend is a share of the profit that the company distributes to its shareholders. Dividends are an important component of stock returns. Since 1956, dividends have contributed nearly one third of total equity return, while capital gains have contributed two thirds. We will come with more videos later so that we can learn together and start trading to achieve financial freedom at the earliest. If you like our videos, please don't forget to like, share, and subscribe. Also, please don't forget to drop your opinions in the comment box below so that we can improve ourselves.